Joining me, this is pretty unprecedented. Like I've used this metaphor before. This is like a combination Long John Silver's, KFC, Taco Bell, Pizza Hut. Paul Merriman, master investor. He's founder of the Merriman Financial Education Foundation, a retired advisor, prodigal grandpa. He's joining us from the Pacific Northwest with one of his heroes, and it's a mutual admiration society, Ben Carlson, return guest, director of institutional management at Ritholtz Wealth and Asset Management. The new book, which is delightful to read, it took me a few hours, Risk and Reward, How to Handle Market Volatility and Build Long-Term Wealth. Did I encapsulate that correctly?
Nailed it.
These are, in the words of Paul Merriman, and I listen to your pods and I read you both religiously. You're very well published, omniscient about markets. You're 360 degrees of perspective, and so I feel like I know you very well. I do want to bring up this meaning of life question to Mr. Merriman. I think of you as like this wise seer up in the mountains, hanging on some branch, I don't know, up in some mountain in the Pacific Northwest. And I've crawled and I've been parched and everything and reading your stuff and listening to it for years. I have a meaning of life question. It's a little bit like those Tootsie Roll commercials where, you know, they ask the owl, how many licks does it take to get to the Tootsie Roll, so never Tootsie Pop. You, sir, a lot of your research that I follow is that you could do better with some extra effort, with some smart diversification for units of risk and reward. But I've been meaning to pose this question forever to the wise seer, Mr. Merriman. Who in the heck was investing in the Standard & Poor's 500 index 50 years ago? You're citing the S&P from 40 years ago. It's only come into my collective consciousness, I'd say, for the last 30 or 25 years. I talked to brokers in the early 80s. They might have bought IBM for a few points, Digital Equipment and others, and of course, Jack Bogle and Vanguard and the Vanguard S&P 500 index. And yet you're citing this stuff over 100 years. So it's like, is it purely in the theoretical, or were there people out there actually buying this storied S&P 500 index fund?
Well, when I came into the industry, Robin, in 1966, we didn't have the S&P 500 certainly as an investment. We didn't have an index fund, as a matter of fact, then. But the academics have taken it back to the 1926, I think, is the starting point generally. And so what you see when people are quoting 100 years of performance is yes, it is hypothetical. Who knows how the S&P committee might have put the portfolio together? It's an interesting long history, but it gives you an idea, and the numbers have tended to stand up over time in terms of the long-term return. So I don't feel guilty as long as we tell people these numbers, nobody made these numbers really, but they do give us, I think, some guidelines of what we might get out of that particular index over a lifetime, not over the next 10 years, but over a lifetime.
It feels like there might be logical fallacy in that, especially when I get to the more esoteric places like smaller companies, value companies. We have information now available at the millisecond, and hedge funds and high-speed traders doing these things and exploiting arbitrages. I mean, Ben, we could cite this stuff left and right. I know Barry Ritholtz said if these two guys, you remember that stat, they go off to World War I, one decides to put his $1,000 in a mason jar, the other invested in whatever the S&P 500 would become. And then 100 years later, one is worth $30 million, the other lost 96% of its value. I don't think that anyone, I mean, even if you take a mini Paul Merriman and you put him in 1918, I don't think he would have had that prescience. He would not have had those resources.
No. I mean, we've learned, though, we've had the help of the academic community. I've never personally counted on Wall Street to help me do the right thing. I'm not anti-Wall Street, but I just find that the academic community has given us more information in terms of perspective. One of the things I love about Ben's new book is that it gives a perspective of investing as well as any book I have ever read, and not just the upside, but well done, Ben, on the downside, because on Wall Street, that part tends to be missing.
Ben, right, jump in.
Yeah, hope is not a strategy. Robin, I love you pushing back on the historical stuff, because it is true. Like, you couldn't have reinvested dividends in the past, right? But I think one of the benefits of today is that let's say you're right and maybe returns are lower going forward. The great thing is fees were so much higher in the past, right? The first index fund from Jack Bogle at Vanguard had an 8.5% front end load, meaning you had to pay $8.50 for every $100 you invested. They got rid of it a few years later, but it was the bid ask spreads on stocks were so much wider. There wasn't as much liquidity. So now you have these like tax efficient vehicles, right? The ETFs, plus you also have the 401k and IRA that didn't exist back then either. So investors actually have a better shot at getting, better net returns, net of everything, right? Net of fees, net of taxes, net of slippage costs and transactions. So I think that's one of the cool things about today is that we've essentially bulldozed the barriers to entry in the stock market. It's way easier. When I went to buy my first Vanguard index fund in 2005, when I got out of school, I said, hey, I want to buy an index fund. And they said, that'll be $3,000, sir. That's our minimum. And I said, I don't have $3,000 though. Now you can invest in fractional shares. There effectively are no minimums and there are no fees to invest, which is an awesome thing for individual investors.
So when we're flogging the historical numbers, and I don't know what the logical fallacy in Latin would be, ex post facto, logic hoc, whatever it is, but we're superimposing the democratization of investing, the liquidity, the death of the stock commission. You don't see commercials for commissions anymore. It's not like Fidelity and Schwab and E-Trade are asking you for that. And you've never had at your fingertips, for better and oftentimes for worse, such a diversity of offerings. Small cap value with a filter, active bond, 3 times double Tesla short, whatever it is. I mean, it's like the cereal aisle or the Gatorade aisle. When I was a kid, there were 2 or 3 jug flavors of Gatorade. Now you can slice it and dice it in a million different ways. And I think it's tempting for us to backdate those numbers. I think, Paul, your crew does that amazingly and goes back and says, had you had the luck and the foresight to invest in smaller capitalization value companies, who, aside from the academics, was offering that 50, 100 years ago?
But I think the important thing about those old numbers are that, for example, I've been talking about the 10 years from 29 to 38 for 40 or 50 years, I think. And people say, well, that's all outdated. That's never going to happen again. But in fact, we did have a market that from 2000 to 2009, even though it wasn't as volatile of 2000 to 2000, it still was the same end result, a loss over 10 years, which means that somebody who actually believed the past had some meaning might have been prepared for what happened in 2000 to 2009. And that, I think, is the value of those old numbers. It tells us more about, again, the risk aspect of it. And by the way, the beauty today is we can see the difference in risk between large and small and value and growth. And we find that when we dig deeper and deeper, there are these kind of interesting levels of risk and how they work together that make it special if the future looks anything like the past.
Now, Ben, you write about this in the book. There are all these different, the but wait, but what about element of it. And you could have said that. I mean, anyone who studies Japan and the euphoria of 1989 and Rockefeller Center, anyone who came of age in investing like I did at the turn of the century, my first job was in the brokerage industry, and I bought all of that NASDAQ slop and, Y2K, Cisco, JDS, Uniphase, telco bubble stuff. And I suffered the lost decade, the worst decade since the Depression as a result, 2000 to 2009. And that has stained and anchored my behavior, thinking that an S&P 500, while great, while probably the best mousetrap ever built in terms of global indices, in terms of capital, cap weighting and getting booted and quality coming in, and it morphs over time, where GE might have been king with Cisco 25 years ago, and now it's the likes of NVIDIA and everything. It's a very dynamic thing. We could do lots better than it with the technology we have, with the data we have right now. But when I read your book, I also see the perils of too much diversification, too much tinkering, too much logging in and scrutinizing the numbers.
Yeah, it's funny. I think there's never been a better time to be an individual investor. But the point you're trying to make here is that it's never been easier to be tempted by other things, right? The siren song of, well, this new ETF looks awesome. Why don't I have some of that? And this looks great. And so, Robin, you mentioned I'm a Michigan person. The White Stripes, when they first came out, they did this awesome album. And they interviewed Jack White afterwards, and they said, how did you write it in 10 days? This wonderful album, right? White Blood Cells. A lot of people think it was one of the best albums of the first 10 years of this century. He said, I had these rules in place. And there was I'm not a musician, but it was like no bass and no covers and no slide guitar. And someone asked him, like, why would you limit yourself and make it? He said, no, you don't realize the limitations. There's like liberation there. And I think that's what investors need now, is some sort of limitation. you're right that you can take diversification too far. I do think diversification is how you protect against that lost decade in the S&P, but you can't be going everywhere. And my colleague Josh Brown likes to say a good wealth manager is like a club outside the bouncer behind the rope and just swatting people away, right? You can't get in, you can't get in, you can't get in. And so you have to have some sort of rules to guide your actions so you're not trying to invest in everything.
Incidentally, Ben, Jack White of the White Stripes, and he must make a great fat royalty every time they play Seven Nation Army at any basketball game or outside of MSG. I know this is inside baseball, Paul, but I'm going somewhere with it. He also has a rules-based guacamole that I'm sure informed. You can look it up. He's very particular about what he puts in it, when you slice it, when you put it in. I admire a rules-based guy. Right.
Yep.
So going there, and Paul, I've asked this before. We all admire Jack Bogle, the patron saint of investing. I want to toot my horn a bit as I had the crazy luck of being on a Metroliner train with Jack Bogle on March 9th, 2009, to go and profile him for Business Week magazine. So all of this great stuff, he had a heart transplant. We are at a generational market low. And he's comparing that to what his mindset was in March of 2000. And I'm profiling him, and there's just blood on the streets, as you guys know. And he's saying, if I was in your position, if I was a young person right now, I would, and I'm not a market timer, I would be overwhelmingly in equities. They're not going to let the system fail. The system is going to recapitalize. It will recalibrate. There will be light after the darkest part of this. And indeed, Ben, as you guys have posted, have we seen something on the order of 17% annual returns for the last 17 years? I mean, this has quietly been a rip-roaring bull market. But the corollary, the problem is everybody, Paul, comes up to me right now and says, this is priced for perfection. We're due for something. There's going to be comeuppance. And I'm sure you hear that a lot.
I do. And the fact is, from 1975 to 1999, it was a 17.2% compound rate of return on the S&P 500. And of course, we know what that was followed by. 3 disastrous years that took the S&P 500 down over 50 and took the tech index down about 80. And so I think you're right. Once you've lived through that, and I've lived through that since I've been around this thing since 1966, many times. And so I still believe that is as baked in the big declines as the big upside is going to be baked in from time to time. But we all turn into market timers at some point. We all start making decisions about things based on what we've learned from the past. And the one thing that seems to be the most difficult, and I think the work that Ben is doing is so important, is giving people the information that they will actually buy and hold. Because it's hard to find an honest to God buy and holder in this world. And you got to have a lot of information of historically, I think, before you can really learn to be a good buyer.
Indeed, as a Business Week alum, I'd like to stamp it for you, gentlemen. It was the infamous cover, Death of Equities at Business Week, right on the eve, right on the foot of the mountain, if you will, Paul, of one of the greatest bull runs in history, right? Where it was such a backwater. The market in the early 80s, it could have yielded 6 or 7%. So what? I remember, in my memories coming to the United States, and I will go to my deathbed with this story. Dad would take me to the American Savings and Loan in North Miami Beach, and we'd check out toothsome 15 or 16%, savings accounts, and they'd give me awesome blenders and toasters and maybe even the possibility of a microwave if, we were to tap a mortgage or a home equity line of credit. And of course that doesn't happen. But I go back and whenever I give speeches, and my dad passed away, 2 years ago, I'd say, Dad, instead of taking a knee and saying, this is your passbook savings, son, let's put it in the Standard & Poor's 500 index. But who, what, which 800 number would I call? That wasn't there. It was a backwater investing back then, Ben. And we take for granted, even in 2005, to say that you have to call an 800 number, get a quote on a Vanguard index fund, and then somehow wire your $3,000 there. It's nothing resembling what we have today with Robinhood, with fractional shares, with money that you can do on your phone. You can do a run on a bank, as we saw in 2023, on your smartphone with a bunch of other people on a plane.
Yeah, and the numbers show that this is helping young people invest, which I think is great. The Wall Street Journal had a piece this week talking about how the percentage of people under 30 with an IRA has doubled in the past decade, which is great. You see young people now. Some people worry, well, young people are speculating too much and they're trading options and they're doing all these crazy things. I think getting people involved in the market is a good thing. And I think people, who make mistakes and pay their tuition to the market gods eventually kind of figured out. And part of it is you're talking about the stock market is not easy. It's lumpy. The returns are lumpy, right? So you have the lost decade followed by a long, if you think about it, no one in their right mind was predicting we'd have a bull market this long coming out of the 2008 crisis. Everyone was, remember in 2011, it was, this is the new normal. Get used to lower returns, people.
Yeah.
This is, and so
I
think
I profiled PIMCO during the new normal. I mean, that was a perfect contraindicator. Stock returns are not going to be the same. Companies are going to be selling stock. Credit is going to be an overhang for a decade plus. And no.
But after the bad times, people think those bad times are going to last forever. And that was the Death of Equities cover, right? And in the good times like this, people think these good times are going to last forever because it's totally shifted now. The 2010s, most people were still investing from the fetal position and worried about another crash. Now that's a distant memory. And people are kind of thinking like, well, wait, this bull market is just going to last forever. We're good. This is awesome. Every time the stock market falls a little, I put money in and it goes right back up. And obviously that's not going to last forever either. But the problem is we don't know how long these cycles can last. That's the hard part. No one knows when this bull market will end. And will it end with a bang or a whimper? We don't know that either.
And another indulgent confession to you gentlemen is in my investing lifetime, which I'd say now is about 30 years adulthood, I've developed something called the Iranian Relative Contrarian Index. If an Iranian relative I did not know I had, and I've done this on NPR, approaches me as they did in February of 2000 and says, Faisal, I am your mother's cousin. Yes, I have met you before. Oh, you are a baby, but what do you think of Cisco? And I was like, I don't think of Cisco, but it's like a little, shoe shine moment. The flip side of that is in 2009, when I was markets editor at Business Week, right before I went off to profile Mr. Bogle on that Metroliner train, I've had every art director, back desk, all these people tapping on my window, older generation people saying that I'm going to liquidate my McGraw-Hill 401k. We're going to be eating cat food in 6 months. Your parent did not survive the depression. Mine did. And I was thinking about it, Ben, reading your book in that PTSD anchoring. And I said to them, look, I'm a young guy. And yes, I'm a whippersnapper, cocky market reporter. And all I've read is that the odds are stacked against us being in a breadline in 6 to 10 months. The Fed will throw everything at this problem. Ben Bernanke studied the Great Depression. The government and the Fed, they have their fingers, the fat finger on the scale against this not happening. And they will recapitalize the banks and they'll send the stock market higher. And I go back and I talk to them and, to think that you're nearing retirement and you had to liquidate your assets. And that is a real hazard that you had if you did ride the market, if you did play the markets. It's fascinating. And no one's really writing about this right now, how we're on the other end of that. And people are not willing to say that, gosh, I lost the fear, as you call it, Ben, the fetal position.
And I do think, Robin, that somewhere in the industry, money is being made as the money tends to move around based on what recently happened. I know in our particular case, because in the 90s, we were recommending a balanced fund, big, small, value growth, U.S. international. It didn't do well compared to the S&P 500.
And then don't you call that having to say you're sorry, Ben? And a lot of people have said that, diversifying and facing your investing committee and saying, hang in there. It's like crying wolf. We will prevail. We will be vindicated.
And then we were vindicated the next 10 years. And all of a sudden, we were the favored advisors. We looked like we were smart. All we were doing is what the academics told us to do. We didn't do anything original except diversify. And now, of course, we're back to the other side of that coin, and we're into where you want to be all in the S&P 500 or something like that. I just think the industry will do fine in the long run. The question is, how do we help the investors do fine and stay committed to that buy and hold strategy?
Full disclosure, I'm Robin Farzad. It is my joy to be joined by guys, double trouble here. Wonderful truth-telling tandem. Ben Carlson, Director of Institutional Asset Management at Ritholtz. The book is Risk and Reward, How to Handle Market Volatility and Build Long-Term Wealth. Our friend out in the Pacific Northwest, the wise seer, Paul Merriman. You've read him in Market Watch. Of course, he is the founder of the Merriman Financial Education Foundation, retired advisor, prodigal grandpa, tucks away money. I listen to your voice every week. You don't even, there's no organ music on your pod. You just go right in. You say, if you look at table H4A, and I was like, yes, that voice. I love it. And so I wanted to look, I have a face for radio, but Ben, I want to ask you, and you must get asked all the time, is the S&P 500 right now, it's a problem. We love it. It's great. Mr. Market has done great by us, but it is in some respects a glorified tech fund. If 40% of it is in these Mag 8, Mag 9 companies, NVIDIA, Meta, all of those things, you could turn around and ask a retiree and say, I never signed up to buy a tech growth fund, but that's what the S&P in its authentic state morphs into in times like these.
I think one of the best things about index funds is the fact that it'll pick the winners for you, right? And if you think about it, like a company like NVIDIA wasn't even in the top 10 in 2020. That's not that long ago. And now it's the biggest company in the world. I was looking at this the other day. In 2023, NVIDIA was still a $750 billion company. Today, it's 5 point something trillion. So that growth, you're right, it can be scary because there's the concentration risk. And you worry like, hey, if the AI trade unwinds, if there's some sort of speed bump in the CapEx from all these spending and companies, like, is that going to take the stock market down? And I think that's a legitimate worry. The great news is it's never been easier to diversify into other stuff if you're worried about it. Paul talked about it. If you want to own different market caps, small or mid caps, if you want to own foreign developed stock or emerging markets or boring old dividend stocks.
Why was Jack Bogle, when I asked him, you probably asked him too, Paul, I think you did. Why was he dismissive of international investing? A lot of times he'll say that's just currency, or at best, if you complicate anything for an investor, it's going to be hard to keep up with it. But I look at the numbers, Ben, as you do. I mean, if I took a snapshot of the world in the early 20th century, Argentina would have had a huge economy. England, right? Korea and Ghana were the same size in the 1950s. Now Korea is this juggernaut with Samsung and Hyundai and AK and others. Not diversify into the rest of the world. How much diversification, Ben, and this is a meaning of life question for you, is too much diversification? You get at it in the book, and you get at the danger of having too much variety out there, too much of kind of processed ETFs.
Yeah, I think Bogle says that 40% of the revenues for the S&P 500 already come from overseas, so you're kind of covered there. But the way I look at it is it's different people, it's different countries. You do get the currency. I think that's also a form of diversification. If you're worried about the U.S. losing its place on the mountaintop, right? Owning international stocks is actually a pretty good hedge against that because you also get the currency diversification. And the thing is, you talked about Japan being on top of the mountain in the late 1980s, and it was actually a bigger stock market than the U.S. at the time. Right. And so I think diversification doesn't protect you against bad years or even a bad 5 to 7 year period. But you want those really long-term cycles where something really bad goes on. That's what diversification does for you. And so I think owning international stocks is a great hedge against that. And my hope is that something like a technology like AI actually flattens the world a little bit and brings the rest of the world up to kind of catch up to us in some ways, because the U.S. is already 65% of the global market cap. It's a huge piece of the pie already.
Again, stop and think about it. A handful of companies in the United States, which are national champions, I applaud them for innovating. Jensen Huang is a rock star. He dresses like a rock star. NVIDIA, when I was first covering the company, was interesting gaming play with a crunchy CEO with a great folksy Denny's stories, and now it's the indispensable semiconductor thing on the planet. And that fever has seemed to have captured Korea. Korea's stock market is up 4-fold, 5-fold. Samsung, which, Samsung back in my day, it was like that joke brand that if you were going to buy a cheap TV at Costco, you'd leave home with a Samsung TV. But we know it's much more than that right now. But the other cautionary tale, as they say in your book, Ben, is what about Japan? What if this country, what if retirees were to face a 3 decades in the desert, 3 decades plus type thing in the desert? What even is the implication?
Well, we'd have to get a much bigger bubble in the meantime to get there. Japan was like an otherworldly stock market and real estate bubble, right? It was trading for 100 times earnings. So we'd have some big gains in the meantime to get there. I guess the good news is, I said Japan was one of the biggest stock market in the world in 1989. If you had just invested in a global stock market at the time, right, inclusive of Japan being 45% of the index, and it went from 45% all the way down to 5%, right? So think about the U.S. going right now from 65% down to 25 or something. You're right. There'd be anarchy in the streets probably here if that happened. But
Paul, if I had told
that happening, the world did fine. That's the thing. And
if I had told you, Paul, in the 1960s that what they called back then Red China would be the economic juggernaut, would be the manufacturer to the world, that the wealth that would flow to the likes of Brazil, Peru, the rest of the developing world, the standard of living dividend that you get in the United States to get an iPhone or a cheap DVD player or all these different things that we're using, USB mics and the like, because Japan is the world's tech manufacturer. And now that's extending to clean tech and battery technology and even cars. That would have been a bit risible.
Yeah. And I think Ben does some amazing things in this book. On page 189, I'm actually making a list of 10 pages every investor should look at in this book. But on 189, he does this wonderful thing. He shows the countries and how they did in the 70s and the 80s and the 90s and 2000 and 2000. And I'm going to have people go in there and circle the USA and notice where the USA was in the 70s and the 80s. And we were not number one very often. In fact, I think once we were number one, and we just have this home bias, and that's very common, as we know, in the industry. But I think that one page itself, Ben, I think makes the book worthwhile to somebody who's trying to figure out, does international belong in my portfolio?
Ben, where did I see in Ritholtz Wealth Research? I swear I saw a slide that showed that Sweden has had a crazy 4 decades.
Yes.
How in the
Right,
world,
right?
how can
Number
you have the
one.
best of both worlds? How can that be number one? How can you have a statist, kind of generous social safety net, brings in many immigrants and the like, has some products, but I'm not talking about Saab cars. I think about IKEA. I think about Ligonberries. I think about a small, monolithic, forward-thinking, progressive culture, but no one in the world would have imagined Sweden.
Well, you talked about China before. South Korea in recent months has passed the UK in terms of stock market size. It passed India this past week. Think about trying to tell someone that in the 1950s when South Korea was essentially torn apart, right? That it would be now one of the biggest stock markets in the world. And that's the point of diversification. Is it's a risk management tool, but if you cast your net wide enough, you also get some winners that you didn't expect. Right. I think that's the point, is that you're opening yourself up to winners from unexpected places.
Paul, and then when I think about the portfolios, that you guys do a tremendous amount of work, you and Chris and Daryl and everybody at the foundation, and slicing and dicing these numbers and looking at the factor tilt of small and value and international, which again, without getting into Wonkistan and the weeds, this stuff is available now. It used to be the province of having to go through a dimensional type advisor. You have to sign up and understand that you know this. And does your advisor get that religion? Now it's available with a slightly higher cost basis, but you could buy it commission free on Fido, on Schwab, on any of these things. If you want to be a factor investor, if you truly want true small value exposure to kind of feel that spirit of 2000 to 2009 where everybody else was suffering, you can do it now. But where I struggle with when I look at all your portfolios is, how much is too much? Do I need small value in the US, a powerful, powerful tool, but I also need small value international? Do I need emerging value small? Do I slice it into 15 different ways? Or could I possibly just set it and forget it the way the S&P 500 does it?
Well, if you really want to take advantage of the different factors, you can do it with two funds. As a matter of fact, whether you have U.S. or international small cap value, the academics expect that premium is going to be there in both cases. So if you're willing to wait out a particular country's market struggling for a period of time, you could do it just with the S&P 500. There's your large growth. There's some large value. And there is the best large portfolio in the world, probably. But at the same time, if you go to small cap value, and I'm looking at DFA and Avantis as being the better providers of a factor-based mutual fund like that. But if you want to have small and you want to have value, you can do it with two funds. Small value, gives you small. Large cap blend like the S&P 500 gives you exposure to the large growth and some large value.
Correct, but that, per the conversation of 5 minutes ago, that's weak sauce for international exposure, right? I'm getting a little souffant of that.
Well, I made the point that you have to be able to wait out the underperformance of a particular country if you're not going to diversify internationally. Adding international asset classes is not expected to increase the return over time. It is expected to reduce the volatility some.
I see.
And so That is really about volatility management, not necessarily about long-term return management.
But to explain for our listeners, it is agreed now and is desired that adding small in value, tilting, putting your thumb on that corner, on that quadrant, look for smaller, profitable value companies that over time, the half point, the whole point, the 2 points, ideally over 50 years, that is millions and millions of dollars more for your retirement. Paul, I mean, Ben, is that generally agreed, or is that up for debate now, where we don't know if that's a function of the past, a function of people looking through stacks of, equity research papers and the like, that premium no longer exists in this market. It's too efficient.
When I think about diversification, what I'm looking for is complements. I want something that is going to offset if one thing doesn't do well. That's, I think if you get outperformance, I think that's a bonus in my mind. So the way that I look at it is like you want something that, so if the S&P 500 is more growth and momentum, the smaller value can maybe offset that when the growth momentum slows and the value picks it up. So that's, I think what you want is this sort of, yin and yang. And that's the idea of the risk and reward. And Robin, everything you're asking, I think is great questions. It's the way that I view investing as a whole is just it's trade-offs. Like what trade-offs are you willing to accept in your portfolio? And if you're going to be overly diversified in all these different categories that you mentioned, like the biggest question is, will you be able to rebalance into the pain when they don't work? That's the thing that you have to answer. If you can't, maybe having that 2 or 3 fund portfolio is better for you. But if you can, then I think it makes sense to, you're rebalancing when the thing's doing worse. You're selling a little bit of what's doing well. You're buying a little bit of what's not doing well. And that helps improve your returns over the longer term, or at least decrease your risk, as Paul said.
Full disclosure, stay with us. This show podcast to NPR, Spotify, Apple, all of the fine podcatchers. And of course, watch us on YouTube. I certainly know my mother-in-law does. You can follow us. All the links are at one neat place, fulldradio.com. Again, fulldradio.com, and connect with us on whatever, LinkedIn. I'm no longer on Twitter, but I am on Instagram. I'm sure I have a Friendster handle somewhere. And a shout out to our radio listeners out west. We are on KPPQ in Ventura. We are down in Asheville, North Carolina on WPVM in the Great Green Mountains of Asheville. And of course, across the great Commonwealth of Virginia on UVTF, Radio IQ, Virginia's NPR news source. Holler if you too would like us on your air. My DMs are always open. And of course, catch me every week on both CNN and NPR's Here and Now. If you are just joining us for this special kind of truth teller tandem episode, I think Ben is yawning. I'm not impressing Ben. Ben is a very high caliber. Back when I first met you 7-8 years ago, you were impressed, but you're like, when's my lunch appointment here in Grand Rapids? But Ben Carlson, Director of Institutional Asset Management.
People tell me I have a resting board face. I can't help it, Rob.
No, you have a great looking tan, and I have a face for radio, unfortunately. His book is Risk and Reward, How to Handle Market Volatility and Build Long-Term Wealth. It's a great gift for new graduates. I know I'm not supposed to tout this, but it's a quick, fast read with universal things. It's not inside baseball. Again, we can wonk out on those things. And of course, our wonderful uncle out in the Pacific Northwest, the patron saint of Small Cap Valley, Paul Merriman, co-founder of Merriman, the Financial Education Foundation, a retired advisor. His self-actualization in this age involves passing the torch on to others, teaching people, transmogrifying this into other generations. I want to throw a jump ball out to either of you. What is inflation? What is inflation? We just felt inflation, capital I inflation, for the real time, and it put people in a lousy mood in 22 and 23. And Paul, we haven't had that spirit here since 82 and 81, and it's caused people to think through things in the real time. You could say now that this 17% market did cover you for inflation and then some, but it's something that there's very little institutional memory about, Ben.
Yeah, I'd never experienced inflation like this sustained that high before. And I'll be honest, I study behavioral psychology and how people react to stuff. I was a little surprised at how angry people were by it. Right. And so the longer term piece about inflation is like, this is the reason you invest, right? You don't bury your money in the backyard. If you have a 3% inflation rate over something like 20 years, is going to cut the value of your dollar in half. Right. So that's the reason that you invest. But it's also the reason that you need to have a handle on your household budget as well. Right. It's not just like the government data inflation that matters. It's like, what is your own personal inflation rate? How do you handle your own standard of living?
Paul?
Yeah, if people had a sense of history, and again, Ben, I think you do a great job on inflation in your book. If they had a sense of it, they would know to be prepared for it as a likelihood because it's happened a number of times before. It's not the first time. And what people don't realize, it's one of the biggest risks we take. And people who aren't taking enough risk with their investments I think, are putting themselves at long-term risk of not defending against the impact of inflation. When we look at our tables, a $40,000 income, which was a great income in 1970, in order to replace that, you need over $200,000 a year today. And so when I came into the industry in 66, I used to do workshops and I used to ask people, what kind of money do you want to have someday? And invariably, it was $1 million. It was always $1 million. When I was 40, it was still $1 million. And when I talk to college kids, I teach on a quarterly basis, it's still $1 million. That's not the way it works. They probably need $5 million if they're starting to invest right now to retire, particularly if they want to leave money to others. But it is such a huge risk. And what the fascinating part is that when you look at the long-term returns of equities, it seems to kind of adjust to the inflation that you experienced over that period of time, which means it's way more dependable than putting your money in a money market.
And yet, Paul, the infamous Business Week cover from the late 70s and early 80s says that inflation was killing the stock market. Alas, 1968 to 1982 was also this time in the desert.
To be fair, here again, if you looked at the S&P 500 kind of investments, at that point that article came out, that might have been mostly true, because people were generally in the process of getting out of stocks from about 75
and you experienced 73, 74, which was traumatic.
I did. Yes, I did. And so what we know is that if you go back to that late 70s, when that article came out, if you had a portfolio that was diversified, big, small, value, growth, U.S. international.
But again, nobody did. I love you, and I don't mean to kneecap the wizard. I just will never get a chance to do this. Paul, nobody did. They might have had a couple of, digital equipment, Westinghouse, Eastman Kodak, and they call their broker and pay $100 commission. Nobody had that.
Well, they could if they had mutual shares.
But who? It was such a backwater.
Robin, you've been waiting to do this, I feel like.
Yeah, it's one of those bent noirs. Like I used to be like Jerry Seinfeld, like, why isn't Apple in the Dow? You're robbing us. Where's Amazon?
You talk about how the past was different. It's funny because think about how much more equipped corporations are to handle inflation. Think about everything that's been thrown at corporations this decade. 9% inflation, supply chain shocks from COVID, Liberation Day tariffs, all the stuff that companies have dealt with. And the S&P 500 companies have improved their margins to that, right? These companies like allowed the consumers to eat the inflation on their behalf and still improve margins. And the stock market is up, 15% per year in the 2020s, despite all that stuff that's been thrown at them. So I think corporations are better at handling inflation than they were in the past.
And it's unreal, as you guys at the compound and others throw off, is what if by any objective measure, price to earnings, cyclically adjusted price to earnings, the Fed model, whatever wonky stuff we want to get into, what if this is still the 1996 inning of something that ended in 2000, right? Alan Greenspan came out and cited irrational exuberance. Was it at December 1996? Against all odds, the market is still churning ahead and hitting all-time highs.
Yeah, good luck predicting the end of this stuff, right? Paul, you've lived through more cycles than me. Have you ever seen anyone who can predict what inning we're in and what cycle, when these cycles end?
No, and we don't want to, because the minute we get in that business, we become by default a market timer. And that's why it's so difficult in this industry to not be a market timer, because we're all focused on all of these things that are going on and what they might do to the economy and to our pocketbook. I contend that all of the things we've learned since 1928 represent what the future will look like in the stock. And again, it's in Ben's book in here. There's a page that is devoted to showing all of the returns year by year since 1928. And it shows how many times did they make 30 plus, how many times did they make 20 plus, how many times did they make 10, minus 20, minus 30. That is exactly what the future is going to look like, I think. The only thing I can't know is what the sequence of returns will be. But the numbers, and what I really wanted somebody who takes this book to do, every year go in, open up that page, write down this year's number and see where it fits on that series, because you're going to find out you're going to be putting numbers under other numbers that did just the exact same thing, but for different reasons. And that's the part that it's hard for, I think, for people to get. All these reasons matter, but they don't matter unless you're a market timer.
You know, Ben, what's interesting is you talk about 2005 as your investing career with a hesitating start and trying to get the $3,000 to Vanguard. I'm sorry. And then here's Paul Merriman talking about the early 60s, and yet it's a mutual admiration society. He's like your hype man. You remember Louis Farrakhan used to have theme music behind him everywhere he'd go? Like, Paul Merriman can cite pages of your book. Like, this is, you know, in my tradition, like Jewish custom, it's called a shidduch. You bring two people together. This guy is your fan club out in the Pacific Northwest. I love it. He calls you a truth teller. And I'm there saying to people like Ben Carlson, he and Jason Zweig are like the I Claudius figures of the stock market. But I digress.
No, I think one of the reasons that Paul and I have a shared admiration is because we produce a lot of content on the markets. I think it's because we enjoy it. Right. There's a lot of people who just find this stuff to be mind numbing, or I think that the markets are one of the most fascinating places on earth because of partly the numbers, but also because of the psychology behind it and how people behave and the decisions they make. And I think just it's like this laboratory for human emotion. So that's why I love it, because it's the facts and the feelings. And if you don't get, you have to get both of those right if you want to succeed in the market. You can't just have one.
And the book that I read for psychology,
Ben, the book.
The book is Your Money in Your Brain. I have read it 6 times.
I love that one too. Me too. One of my favorites.
Ben, let me ask you how old you are.
I will be 45 this summer. Father
and
of
I just
3.
cracked the 5 handle last month. 2 months ago.
Congratulations.
Me, but are
Do you have a midlife crisis yet or not?
Many midlife crises. Heavily medicated, and increasingly I put my faith in the cans of Celsius. But that's neither here nor there. Are you romancing the idea of retiring early? And what is that number? I'm sure you get asked all the time. Tell us about the FIRE movement and what that number is. People come up to me, as Paul Merriman said, like, back in the day when $40,000 was a great salary, could I ever make $1 million? Now they're thinking arbitrarily with a 4% withdrawal rate, and this is how much I need, that this is the nut I will need to retire. I know you and Mike and the others address it a lot in your podcast. There isn't a one size fits all, but there's also an aspiration in our generation to kind of maybe call it quits a little sooner.
Yeah, it's funny. The number people have thrown out in the past was always, people love round numbers. So people say, I'm going to retire at 55. Why is it always 55? I don't know. It's a round number. But people now younger are saying, no, I want to retire in like my 40s, right? And I think the hard part is there's just 2 problems that I have with the FIRE movement. I think it's great that people have really high savings rates.
And for our listeners, what does FIRE stand for?
Yeah, financially independent, retire early. So it's people who have like a 60, 70% savings rate, and they want to save and save and save, and then just live off of their investments, right? And the hard part is, first, people are living longer, right? People who retire at regular age now, we're talking 20, 30, maybe 40 years of retirement, right? I think the odds of, if a couple retires at 65 today, the odds that one of them will live to their 90s is like 60%. It's a really high number. So people are living longer because of advances in health. And 2, I think people get meaning from their work. And there's something that if you have nothing to do with your time, you know, the relationships you form on the job, keeping your brain, you know, going. I think there's a lot to that, and finding meaning. And you don't find a lot of meaning in money. There's not a lot of meaning involved there in just having a pile of money. It doesn't really do anything for you. So I think that's the downside. If you have nothing to sort of do to keep yourself, you know, mentally fit, and the fact that you're going to have that money last a very long time.
What is the opportunity cost of money, in your opinion, Paul? Is it the T-bill? You know, if I get asked to use my money, that's the very fundamental hurdle? Or do I have in mind, like, I'm more sophisticated? You talk to somebody like a Jeffrey Gundlach, the bond manager. For him, a 6% is table stakes. That I can, in a market with treasuries and corporates and agency debt and everything, that's my minimum acceptable thing. I get asked this all the time.
Yeah, I mean, that's what I use, and that's what I've been taught to use, is the riskless return. But Ben, what do you use?
Yeah, that makes sense to me. And the good news is those yields are much higher today than they were in the past, right? In the 2010s, you couldn't get money on, call it T-bills, we'll call it cash, right? Cash equivalents. You were earning nothing for many, many years. So now that the fact that you can get 3-4% and on government bonds, maybe more like 5%, this is a good thing for people. higher
And
yield.
in the 2010s, when that was being called financial repression by the Fed, they were smoking you out of the safety, out of this. It is engineered. It is flood management. They do want you putting your money in risk assets. Back then, it was housing, it was stocks, and mission accomplished. When you're up 17% a year over 17 years in a very peculiar time where nobody, again, from the Iranian relative contrarian index, no Iranian relative has been calling me. They called me crying from their brokerage firms in March of 2009. No one has accosted me about NVIDIA or Bitcoin or data centers or anything yet. So there might be yet more room to run. Go ahead, Paul.
I talked to some of your relatives back in 1982. In 1982, I got a 16% 5-year CD out of a bank in Chicago. And I had people, and I was just starting mine. I retired when I was 40. I was just starting my investment advisory firm, which was just for fun. I was not doing it to make a living. I was just having fun. And a couple came in and wanted to know, why should they ever put money in the stock market when you were guaranteed these kinds of returns in the banks and with CDs and treasury instruments? And of course, those people then went through one of the biggest bear markets in bond market history for the next 30 years as interest rates went down and down and down.
That was a bull market. That was a spectacular time. This is my question. You read my mind almost. Were you able to go in and buy a 30-year treasury yielding in the teens in the early 80s? Was that actually possible, or did they limit it to shorter maturities?
I don't remember exactly. What I do remember was the reason I didn't go longer than 5 years is because I was also caught in the trap. I thought rates were going to go higher. And I didn't want to lock in 16% when I knew I was going to get something better.
And Ben, look at the comparison right now. They used to call it the 30-year bellwether bond is barely yielding 5% right now. And I'm thinking, you're really expecting me to give you my hard-earned money and to lock it up and the duration risk and everything for 5%. When as a kid, Paul is resisting the urge of 15 or 16% because he thinks it could go into the 20s.
Yeah, the book is called Risk and Reward, and I think that's the framework you have to look at bonds in. And I like to accept volatility where I'm being paid for it. And you're right, the volatility you see in these longer term treasuries, it can be massive. And so if you're not getting a really high rate of return on that you can lock in, it's really tough. I mean, if you look at TLT, which is the 20 plus year,
so volatile, ETF, this bond ETF, crazy volatility. It's like
it's still on a 40% drawdown because rates went from 0 to 5% in a hurry. And that's the risk, obviously. Yeah, I think bonds are the anchor and the safety part of your portfolio. And so I don't like to have really long duration in that space.
In the few minutes we have left, I have to ask, and I want to open it up just for whatever you guys to go back and forth with this wonderful Mutual Admiration Society. It just warms the heart. But let me ask you, is there a wild card at play here with such a glut of global savings and liquidity that we almost have an exceptionalism here? Things can only go wrong. We can only get 18% corrections. Things are very short-lived, like that COVID crash, right? I was barely able to get my act together and look at my numbers and my savings and other things. And then the 34% thing overnight, it seems like it kind of, and the year ended up. Is it that there's so much money, generationally, people are living longer? You hear about this $30 trillion inheritance or whatever it is that's going from boomers to younger generations, that always is going to flow into risk assets.
There is a ton of wealth. Being someone who works in the wealth management industry, I'm constantly shocked by how much wealth there is and how much wealth has been created this decade. I mean, you think about it, we had a concurrent boom in housing prices and the stock market, right? We had this one time, I doubt we'll ever see it again, 50% lift in housing prices, right? And people complain about housing costs, especially for the young people, which I get, but most people already own a home, right? And so they experienced a one-time shot in the arm in terms of wealth. The bull market in stocks has been going on for, like we said, 17 years or something. There really is just a lot of money sloshing around. There's $8 trillion in money market funds right now, right?
Is that cliche? Is that one of the cliches you would knock down in your book? There's lots of cash on the sidelines. The easy money has been made.
Yeah, I mean, yes, I don't know if that money's really coming out. That's just people like to have some cash, right? And if you look at brokerage accounts, that's a lot of people hold a lot of cash. So yeah, it's hard to say that it's coming from somewhere. But where most money comes in is just people putting money from regular paychecks into their 401k and their IRA and their brokerage account, right? And that money goes in automatically now for most people. And so that's the big change in the last 40 years, is that you just have this automatic wave of money that constantly comes into the market, regardless of what's happening, regardless of what's in the headlines and what the valuations look like and all that.
Is that a distortion? Is that not reality?
No, I think that's just the new reality. I don't think that's going to change. It has made the stock market vastly more important now than it ever was. I mentioned in the book, during the Great Depression, 2% of households owned stocks, right? The stock market wasn't nearly as important. It's way more important now to society, to everything. Now, the stock market is just an important part of what everyone does now.
Well, each of us has, I think, a different way of making our way through the life of investing, whether professional or amateur. I know about myself. There's always a list of good news. I make a list periodically. There's always a list of bad news. I make that list at the same time. They always exist. And so I know that I have lived my life, and I'm talking about from when I came into the business in the 20s, in my 20s, I have lived with the fear of collapse. I would have a lot of money today, or a lot more money today, if I had not been so afraid of that list B, the bad news. And certainly all that money sitting around in accounts waiting to go into the market, that's good news, I guess, or is it bad news? I don't know where it is supposed to be on the lineup, but I know that my nature is to look at the list of negative stuff. And so at age 82, I have more money than I need. I know most of my money should be in equities, but I only go to 50% because I want to make sure I have enough income for the next 10 years. And really, if I could just let go of that fear that I've carried since my 20s, I would not have 50% in bonds. I would have probably 20% in bonds.
Even at age 82. Even to say, look, I have more money than I need. My grandkids are going to inherit it. I'm going to top off their 529s and when they're eligible to convert to Roths. And like, you are completely justified, sir, in parking your money in longer dated treasuries and just, coasting to retirement.
I know that, but my money is not for me. My money is for Western Washington University and then the kids. And they love that decision, if we might. But I think we have to take risk for who we're investing for, not for ourselves, but for the people that we represent for the future. And so I feel plenty aggressive at 50% in equity. I know that at a target date fund, I'd be 30% in equity, 70% in fixed income.
Ben, I do get asked, Ben, of the possibility, however much of a tail risk it is for you, that, and I know you and Batnick addressed this, that this economy and this AI build out ends up cannibalizing itself. It eats its own tail. We start taking out swaths of early industry, mid-career people who can no longer chip into their 401ks. Yeah. If anything, they start liquidating the SEP, they start liquidating the Roths and other things, and you start to reverse everything that we've spent decades building up for.
Yeah, I really hope that doesn't happen. I hope companies don't, get too aggressive with that stuff. The good news is the jobs numbers are still coming in pretty strong, right? Today they were pretty strong still. The unemployment rate is still 4.3%. So I know there's a lot of worries about what could happen. So right now it's not actually happening, which is a good thing. But I think there are probably going to be a lot of companies who regret not training the younger generation, because who's going to fill the gap for the middle generation then, right? If you don't have that younger generation training. So hopefully companies will look at it like an investment and not ignore the young people, because the next generation has to come from somewhere. Who's going to train these people?
Close us out, gentlemen. Close us out. A great thought. Something that I didn't ask that I should have asked. It's actually, for as much as I love you guys, and Ben, you actually look unusually charismatic and photogenic. You've been working on a tan, like in Mackinac Lake. What is that place called? But it's intimidating talking to people you admire and you follow and everything. It's almost like, I want to be vulnerable, but I also want to be sophisticated. And you guys are going to be like, did I agree to put this on my feed? I'm not sure as far as that is exactly. But please, by all means, have at it.
Well, I will tell you what you didn't ask us about the mistakes, and which is commonly something that we're asked about. And I'm not going to be apologetic about this, but I think the big mistake that people don't get is that they don't get the education they need. I'm going to hold that book up one more time, and I'm going to tell you what, I'm going to Western Washington University, and I'm recommending to them that this book be used in Personal Investing 216, a course that my wife and I underwrite on the campus, because this is what people need to get and increase the probability of success, because the mistake they make is they won't spend a few minutes to really explore the process. And by the way, Ben, Your book on saving, absolutely fantastic.
Ben,
Robin,
I think
swear,
I think you got,
didn't pay him. I swear I didn't.
no.
pay
I
him.
think you have to get Ben. I think you have to get on Paul Merriman's will. No offense. Go ahead.
So I think thinking about the mistakes, I think the one big thing, the lesson I want to like take away from my book is that the most important thing is understanding yourself. Like Paul talked about how he needs to be 50% equities. Like that's what he can sleep at night with. I think you have to understand yourself and like the kind of mistakes that you like. Are you going to regret more that you miss out on big gains? For some people, that's the thing. Like if I'm not taking part in this boom, I'm going to kill myself. Or it's the other way around. Like, no, I cannot take part in the other side of the boom. So I need to be more conservative. And I think there's no right or wrong answer there. It's about knowing like what you can stand personally. What is your emotional makeup? That's the most important question for investors.
Exhale. Wow. Wow. I cannot thank you, gentlemen, enough. This is Paul Merriman, of course, my investing rabbi. Is that a picture of a rabbi behind you too? This is like,
He's a Greek.
oh gosh, but you are effectively my investing rabbi, and I hope I have a place to crash in the lush Pacific Northwest with you. He, of course, is founder of Merriman Financial Education Foundation, retired advisor. You can read him in Market Watch. I love your podcast, Sound Investing. And Ben Carlson really needs no introduction. The book is Risk and Reward, How to Handle Market Volatility and Build Long-Term Wealth. He's director of institutional asset management at Ritholtz. You probably don't remember, Ben, but when this pod first started in 2014, you shouted me out on the Twitters, and I was like, I could be someone. They really love me. They really know me. And now the worm is turned. Like, I can't believe I went on this. It's like
I was like an angel investor in your podcast.
Yeah, it's such a step down. It's such a dilution of your brand equity. But you know what? No harm done, because the only person who listens to my show is my mother-in-law. Needless to say, you're all welcome to come back on this show anytime.
Thank you, Robin. Great fun. Thanks, Ben.
Thank you. Full disclosure, special thanks to Ian Stewart. If you are listening to us on the radio, note that while we cut for broadcast link, the entirety of every interview is on podcast. We are on the NPR network, Spotify, Apple. Watch us on YouTube. You could find them all at one link, fulldradio.com. Again, fulldradio.com. And please do recommend us to a friend. A shout out to our home station, WVTF Radio IQ, Virginia's NPR news source. DM me to carry us on your air, and catch me every week on both CNN and NPR's Here and Now. I'm Robin Farzad. Thank you for listening. Back with you next week.